Now, it would be fair to say that the words special situations feel more relevant than ever in 2026, so it's about time we sat down with Alex Wright. Alex is manager of Fidelity Special Situations Fund, which has a Morningstar rating of gold and also won in its Best UK Equity Fund category at the Morningstar Investing Awards for Investing Excellence back in March. Alex, thanks so much for your time today, really appreciate it. Could we just start with valuations? We've obviously seen a significant period of turbulence in the first half of this year with the Iran war and its consequences. How on earth are you positioning this fund for the second half of the year?
So, as you'd expect, the fund sort of doesn't change dramatically like between sort of 6-month periods. So average turnover of the funds maybe sort of 25-30%. So still very much as we were, to be honest, sort of towards the start of the year in terms of financials being the biggest weight in the fund, and particularly in the banks where we're overweight, and indeed at the margin have been slightly adding to that, so almost 20% of the fund there in banks. But also we're not just in sort of those more cyclical areas. We have lots of other ideas, and indeed that is to make sure that we've always got a diversified portfolio. We're looking for individual change stories, sort of 80 to 90 names in the portfolio as a whole, and that allows us to go right down the market cap spectrum to some of the small cap areas. And so the fund is very diversified, both UK domestic earners, which make up sort of 35-40% of the portfolio, but more than 60% actually sort of international earners, including some of the big things like Total in oil, AIB in banks in Ireland, Standard Chartered in banking in Asia. So while it's obviously investment in the UK market, that does actually give you a sort of a subset of the global economy in there as well.
Sure, and just in terms of being overweight financials, I mean, there's still significant uncertainty surrounding the trajectory of interest rates. So, you know, what's your ideal outcome when it comes to banks?
Well, I guess the beauty of the banks that within a normal interest rate range, which I'd say is sort of between about 2 and 6%, the earnings of the banks aren't that variable. So that is a great range for banks to be able to produce high teens returns on capital. So, and that makes them quality businesses, and they're not priced as quality businesses. So you're seeing those high teen returns from certainly the UK domestics like Lloyds and NatWest, but also increasingly so from Standard Chartered as well. And yet you're trading on a sort of Ps when we look to 2028, so only 2 years out, of about sort of 7 or 8 times earnings. So that's why I'm still really excited by the financials, because you've got good returns that aren't that variable within that range, but it's still very low valuations. Now, obviously, outside of that range is a risk. So sub 2%, it's very difficult to make margins on current accounts because you can't charge people. And then above 6, people have problems paying back their loans. So I think interest rates within quite a wide band are okay. And again, I don't see a world where we get back to sub 2%. I think a lot of the deflationary forces that sort of post-GFC that led us to be there, not just the deleveraging of the banks, which is definitely over, but also the globalization, entry to WTO of China, deflation from China. Again, that has gone away with things like COVID and geopolitics. So I think sort of as long as interest rates stay above 2%, the banks still look really well placed.
Interesting. I mean, just mindful of what you just said about, 2 years doesn't look like it's that far away. I mean, it's 10 years this year since Brexit, and one of the things that's happened in the last 10 years is there's been significant acquisition activity within UK markets. I think that's been one of the big stories. But there's one fund manager we've spoken to that said that, if that pace continues, in the next 10 years, there won't be a UK stock market left. So I just wonder, from your perspective, taking a step back and looking at this picture as a whole, do you see sort of the pace of acquisitions within UK PLC as being a good story or a bad one?
Well, it's overwhelmingly a good one in terms of performance, and indeed you can see that year to date our best performer is also our biggest stock, DCC, which has received a bid. That's a live situation, so we can't talk any more on it, but I think that shows the undervaluation of the market. Now, what normally happens in a well-functioning market is you get IPOs on sort of the other side, sort of backfilling. And so I think it's that story, the lack of IPOs, which is problematic, because I think that maths is not far off on a 10-year view. If there aren't any IPOs, that's going to be problematic for the UK market. That said, it's not that long ago that there were quite a lot of IPOs. So like 2021 and the first part of 22, there was an absolutely bumper load of IPOs through COVID after the market had an incredibly strong recovery from COVID. So that is now 5 years ago. So I think 5 years without IPOs is okay. 10 years isn't really. Yes.
That's very interesting. And of course, the big IPO of the year has been SpaceX very, very recently. Are there any lessons that you think UK fund managers or UK focused fund managers can learn from that, aside from the need for more IPOs?
To be honest, that's, as I said, I focus on stocks available in the UK or occasionally sort of near to the UK, like some of our European holdings. So I don't have a view on SpaceX specifically. No, you'd have to talk to our sort of global managers for that one.
Let's just talk process a second, because one of our analysts says that you are a highly disciplined fund manager. And it strikes me that, with companies like Smith & Nephew, which are in the portfolio or have been in the portfolio, but are also among some of those highly shorted stocks by other traders and investors. There is a need for discipline there. But I wonder, how do you manage the risk of a company's performance not recovering, so to speak?
Yeah, so Smith & Nephew's like a great one, because you're right. When I use as a screen actually highly shorted stocks, so I look at other companies that like are shorted as a contra indicator, because if you think about it, those funds which are short are a forced buyer at some point. So again, no one has to buy a stock, but if you're short, if you don't want to maintain the position, you have to. So if things change positively, I tend to find that stocks that are highly shorted work much more quickly than those that aren't highly shorted, because you've got those people consistently monitoring it. And so it's really key for me to know, what the counter thesis is, like why are these people short? Is it on a time horizon? Maybe they're just thinking about the next quarter, whereas we're tending to look at the next 3 to 5 years. Also, are they looking at the industry as a whole compared to the company itself? So again, we will quite often look at industries that maybe aren't high growth, but where a player can take sort of market share. And then also, are they focusing on one particular part of the business? So I'd say that's particularly the case with Smith & Nephew. Why were we so interested to buy in what has been touted for 20 years as a perennial turnaround and hasn't turned around? And that's because the part of the business that hasn't turned around has done so badly on a 20-year view, it's got to be only a third of profits. So is there risk around that part of the business turning around? No, there definitely is, because this business has been a perennial underperformer over a perennially long period of time. But I think what people have missed is that the other two parts of the business have become 70% of the profits. And those are good quality businesses which are continuing to grow. And then importantly also, the cash generation of the business, again, partly because this problematic ortho business has become smaller, has got better. And so for the first time ever, they've been able to start doing share buybacks. And again, we look for that on the downside. So a bit like on the investment trust that we run, like if the fund's out of favour and we go to a discount, we can add value by buying back stock. And that's the same on undervalued stocks that produce cash. So again, I really like that on the downside. That's the discipline we're sort of looking for, is like, yes, if things go wrong, how big a problem is it? So how big a problem is a part of the business? And then what can the company itself do to sort of help stop the sort of company continually sort of going down? So share buybacks are a key thing we look for.
Sure. And just finally, I mean, we've talked a little bit about SpaceX. I just want to finish on the topic of AI. Does AI keep you awake at night? What's your assessment of how positively or negatively the fund is exposed, so to speak, to AI and that revolution?
Yeah, so I think AI is really interesting. And so again, while there are very few companies, I would say, in the UK that benefit directly from AI in terms of the current build out. So there are a few, a bit like Keller that help build data centers in the US, Mighty that help build them in the UK. Maybe the grid companies like SSE and National Grid. We've sold out of National Grid because it's done so well because of electricity use. Actually, in the UK market, what there is quite a concentration of is companies that might be disintermediated by AI. And so we've done very well, not owning RELX, not owning Experian, not owning Sage, companies that are on very high multiples and are priced as sort of monopolistic type businesses. So very high return on capital, very high margins, pretty good top line growth, a lot of it from pricing. Now, if you think about it, those businesses are ripe for disruption because of those characteristics. So huge profit pools, very high return on capital. So if you're going to try and go after something, that's something you want to sort of go after if you're AI and you can sort of write software code much more cheaply and much more easily. So to be honest, we've been out of those because they were at high valuations rather than being out of them because of that risk. But I think actually, if you think about what AI means, it makes everything more uncertain. So to me, that means valuations for everything should be lower because people were pricing with certainty that RELX was still going to be a great business in 10 years' time and therefore were willing to pay 30 times earnings. It may still be a great business in 10 years' time, but I just don't think you know. And there's a lot of businesses like that. So what you really need to do is pay a lower multiple for that. And I don't see the market as a whole doing that. So that makes me nervous about markets as a whole because valuations aren't reflecting this uncertainty. So I think for growth, AI is probably going to be great. Yep. It should improve productivity, but the way it's going to improve productivity is increasing disruption. Why has productivity been weak? Well, that is because there's a lot of areas that have become monopolized by information businesses that make very high returns, effectively charge a rent for those areas, which may get broken down. So that's exciting from a global growth perspective, but it's pretty scary from a global stock market point of view.
Sure. Alex, thank you so much for your time. For more on fund managers and Morningstar fund manager analysis, check out morningstar.co.uk, where you can sign up for our new revamped weekly newsletter. Until next time, my thanks to Alex. I've been Ollie Smith for Morningstar.